Welcome to the About podcast. Here we explore your financial health in simple and easy to understand ways.
Welcome, everybody, back to the About podcast. My name is Jeremy Scott, one of your hosts here, joined, as always, by Roy Hucke. Roy, how you doing today?
I'm doing well. Thanks for asking.
Oh, fantastic, fantastic. So on the heels of some of our very helpful, practical, not that this podcast isn't always helpful and practical, but on the heels of some of our helpful, practical episodes, we have another one today that I think is going to be one of those places where people interact with their financial life in a very consistent way, and that is about lending.
Yes.
We've probably all had a time when we needed to borrow money for something or another.
Mm-hmm.
So neither one of us being an expert necessarily in this topic, we, of course, got an amazing guest with us, Casey Madigan of Bank of Colorado. Casey, welcome.
Thank you. Happy to be here.
Yeah. So why don't you tell us a little bit of something about what you do at the bank? Like, what does a lender do at the bank? Because I'm sure it's not like, I'm thinking Mary Poppins. And the dad from Mary Poppins, who worked at the bank.
Fiduciary.
Fiduciary. I'm sure it's not quite like that. Or maybe it is. I don't know.
I'm a commercial lender at the bank, so a lot of it's just having meetings, having phone calls, looking at deals and bringing in business, whether it's purchase commercial real estate or operating lines of credit, equipment purchases, lots of different options. But that's kind of my role at the bank.
Mm-hmm. And what would be like the most typical use case for commercial lending?
Well, like most community banks, commercial real estate is our bread and butter. That's what community banks probably do the most of.
Really?
Yeah, most likely. That's a lot of the portfolio that community banks have. But like I said, we're a full service bank, so we do lines of credit, equipment, letters of credit, everything.
I would imagine it's a little easier to have a pulse on what's going on by being boots on the ground, right? Versus, when you look at residential lending, it's pretty easy to say, is this a good value or not? Because it's a house. Right.
The question I was literally just going to ask was like, I assume like residential's mostly like the bigger ones now because it's a bit of a commodity. I'm sure you do residential lending too, but I'm sure that's a little easy, a little more.
I try to stay away from that. Too much red tape for me. I'm going to get in trouble if I do a lot of it.
At the bank level, red tape?
Well, no, just there's lots of red tape, federal guidelines, state guidelines. You kind of have to fit in a box for consumer lending versus commercial. There's a lot more gray area. You can kind of do what makes sense.
Oh, okay.
Oh, that's something I did not know.
So is this mostly small, like local small businesses or smaller businesses for the commercial lending?
Yeah, I do. I deal with small businesses every day, small business owners. But I've worked with companies that make $100,000 in a year and make $50 million in a year. So it's a wide range that community banks service.
Well, cash flow is king, and sometimes you need to hedge a shortfall, right?
Yes.
A small or big company has to do that.
Yeah, and that's probably more like where things like lines of credit and.
Yep. Lines of credit help a lot especially with seasonality in businesses, or if you got to ramp up with inventory, then sell the inventory, pay off the line of credit. Lines of credit we like to see revolved. Definitely don't want to sit there stagnant with the same balance.
Okay.
So let's back up a little bit because I'd like to know a little bit more about you and how you kind of got into this role you're in now and what kind of led you down that path. So maybe start us with your professional banking career and how did it evolve? How did it evolve?
It kind of fell into my lap. Got real lucky with it. Been with the bank about 7.5 years. I wanted to actually be a bank examiner for the Fed. That didn't work out after college, and I got the rest of my life to work. I'll go coach my old high school baseball. So did that for the summer. And then, at the end of the summer, the head coach takes all the other coaches to a Rockies game. And I met our regional president there because they're best friends. And he, send me your resume, and did that and had an interview the following week and job offer a couple weeks after that. So never thought I'd be a banker, but fell in my lap and enjoy it. And about 6 months in, I saw my boss heading out a lot during work days. I was like, what is he doing? Oh, he's golfing about 3 times a week. Okay. Well, I can work hard for about 10, 15 years and go golf for work. So, yeah, it's
Meetings. He's having meetings.
There's a lot of
Meetings.
business that gets done on the golf course.
Yeah.
There is. It's working all the time.
Always be prospecting, right?
There you go.
Exactly. You never know who you're going to run into.
So you went directly into commercial lending at that point, or how did that evolve?
Yeah, so I was hired we have a program called Management Associate. You kind of learn all aspects of the bank and then kind of go where you like, mostly go into credit analysis, so lots of the underwriting for commercial deals. And then did that for about 3 years. Then a position for a commercial lender opened up in our Longmont branch. I transferred down there for about 3 years, and then another position opened to back up at our Johnstown branch and transferred back in 2023. So, yeah, that's kind of my little short journey through the bank, and no plans of leaving at this point. It's it's a real good company. We're family owned, so it's nice not to worry about shareholders, the bottom line, stuff like that. They treat us well, and it's a good company to work for.
So one of the things that we want to do on this podcast is just add value to people and help them have an understanding. So I think one of the biggest misunderstandings is, how does lending work for the commercial side versus the residential side?
Yeah.
Can you shed some light on that? What are the differences and the nuances? And
Yeah, definitely. So, I mean, kind of like I was saying, it's consumer lending, you have to fit in a box. That the reason for that is because it goes back, decades ago to fair lending. You want to make sure everyone's treated fairly. You're not discriminating, or redlining is what it's called, where you're just lending in a certain geographic area and not in maybe a rougher neighborhood. You're only in the nicer neighborhood. So want to make sure you're making credit available to everyone. So that's kind of the main difference. There's also differences in how income is calculated, which I've always thought is interesting. For consumer income, if I were to go for a home equity line of credit, we would look at your gross income. We wouldn't deduct taxes or retirement contributions, and it's just gross income. And you look at debt to income ratios. Versus commercial, you look at net income and you look at debt service coverage ratios, which they're really the same thing. It's just slightly different.
what is the numbers that you guys run by? And maybe you don't know since you're more on the commercial, but if you do, I'd like to know. So having my certified financial planning designation, they kind of we run through these numbers and what makes sense. And what is for a mortgage? Let's say a house. What % of their gross income should they be able to spend on the house that you guys would allow?
So we can go up to it depends on the scenario, but usually we can go up to 42% debt to income ratio. That includes all of your debt payments. Preferably we like probably 36 or below. I mean, if you can only spend 5% of your income on your debt payments, that's really good.
Yeah.
Right.
Well, and 36% is the overall gross number per the CFP that we would recommend to spend on debt payments, all debt payments. And 28% is the number on the home specifically.
Okay.
So home by itself up to 28, all debt together 36.
Oh, okay.
Yeah.
Ideally, and that's a good.
I'm running my own numbers in my head right now.
That's a good number to go by, but it is off your gross income, which I always thought was a little bit weird too, because it's like, well, that's not actually the money I have to spend, right? Because you got to pay your taxes, right? You got to pay your health insurance and your FICA and all that stuff,
retirement, and utilities, and I mean, you gotta live.
So you would think that they would adjust how that's calculated, off your potential net, but I'm sure that makes it harder. So they just said, let's just do gross.
Right.
And most people, if you're, a mortgage is for your primary residence, if you go up to that 40% DTI, it's, you're still going to make that payment because you live there. You don't want to be kicked out on the street.
Right.
Yep.
Yeah.
Well, and I imagine on the residential side too, there's probably some more consumer protections because we're not, the everyday person is probably not as sophisticated, as a business might be, where a business may want to have more creative financing options, that are, suit their needs, which are probably a little bit more unique. Like you said, the seasonality of it, those short-term things. We have a lot of people in our church who are, in agriculture. That's obviously a big one around here, and those are, big chunks of income, spread throughout the year, but they're, you're not getting a steady paycheck if you're a farmer. That's not how it works.
We're a big ag lender. I don't do a lot of ag loans.
Okay.
There's not a whole lot on the Front Range anymore. I know there used to be, but yeah, we're big into ag, and so yeah, we lend on heads of cattle and bushels of hay, and it's I don't know what you guys.
Those are all
doing.
assets, baby.
Yeah, oh yeah.
Yeah, you don't want to repossess your cattle anymore. You want to repossess your house.
What's that smell in the air? That's the smell of money.
Smell money.
So, question for you in regard to the credit, like when people look at your rating, right? How does that work in regards to the commercial side versus the residential side? Your credit score, right?
Well, I mean, for us, our mortgage department, when they pull credit, they pull from all three credit bureaus, so Experian, Equifax, and the other one. Thank you, TransUnion. Versus, commercial, we just pull from Experian, and then that's obviously the only score we have on the mortgage side. They average kind of all three of them. Credit scores are they do come into play very much with lending, whether it's commercial or consumer. With consumer, if you don't have a certain score, then you're automatically not going to get the loan. Commercial, if it's a bad score, there's a reason behind it. There's mitigants to the risk. We can usually still work with it, but
what's the story and how can we protect the bank's assets if we do lend, right?
Exactly.
Yeah.
Exactly.
So do you help? Have you had situations where people came in and their credit's not good enough? And do you guys do anything to help people understand how to make their credit better?
Yeah. And a lot of bad credit scores is because they have missed payments usually, or a derogatory account is what it's called. And it's just, you fix those payments, and it's unfortunate because they don't fall off for a long time. Depends exactly, what kind of loan it was and what the late payment was, but it's usually either 7 to 10 years, and same with the bankruptcy, depending what kind of bankruptcy, it's on your credit report for 7 to 10 years. But, if you have, let's say, a credit card with a $10,000 limit and it's at $9,000 and it's been sitting at $9,000, that's going to hurt your credit versus if it's a $10,000 limit and has a $2,000 balance.
Right.
So there's lots of things that go into credit scores, and I still don't fully understand how they're calculated.
Well, that's a podcast in itself.
Yeah.
Credit scores.
So when you're talking about on the commercial side credit scores, is it the individual's credit? I wasn't sure. I'm always curious how that worked on the commercial side. If I'm a business owner, does my business have its own credit score, or is it me as an individual as the owner? Or
so there is a business credit score. It's called the Duns and Bradstreet. We don't really look at that or pull it, and we don't report to Duns and Bradstreet.
Mm-hmm.
We require personal guarantees for.
Is that what Duns and Bradstreet does?
Well, they do the business credit scoring.
Oh, okay.
Among other things.
So, in nonprofit world, there's always, you run into these things where you want to do something, you're like, oh, we need your Duns number. I'm like, what the heck is a Duns and Bradstreet number? So.
Well, I've actually never even heard of that.
Yeah, you run into it all the time when you're doing banking, or whether you're doing, especially if you're signing up for nonprofit stuff, or different stuff. They ask for your DUNS number, and it's a way of proving that you're an actual entity, in a way. But I didn't know how to do with credit. Interesting.
Yeah, they do lots of things,
Okay.
and like I said, we don't look at them. But with nonprofits in particular, it can be tough to lend to nonprofits because usually there's not a personal guarantee because there's no ownership of the entity.
Right. We have, there's a story about with this building that we're in, which is a church, for those who at home don't know, was built in the 73. The one of the people who was basically head of the council at the time had to personally sign on the note for the building, and take. The church was going to pay it back, but somebody had to put their signature and probably house, or whatever, on the line, for it, because.
And some nonprofits do that,
Yeah.
if they were the founder and they're going to be involved for the next 20, 30 years, and that's the only way they'll get it done, then they usually will sign.
Got it. So credit scores then do play a part on the commercial side, a little bit more ability to massage that than the personal side if you're buying a home versus something for your business. What about the rates? Like, what kind of rates or terms are different between a personal residential loan, let's say, versus a commercial loan? I know those are quite different. Yep.
Commercial rates are generally higher than consumer rates. Historically they were quite a bit higher. I've only been in banking for, like I said, 7.5 years, but in the last probably 10 years, it sounds like the margin has gotten smaller between them. Commercial is still higher, but as far as kind of structure of loans, a typical 30-year mortgage, that's a fixed rate, 30-year mortgage, fully amortizing, so you don't have a balloon payment. A balloon payment is at the end of the term, you have a large payment to pay off the rest of the loan. Versus commercial, and every bank's different, but for the most part, a lot of commercial loans for banks are it can be a fully amortizing loan. So let's say a 25-year term and a 25-year amortization. Difference between amortization is what the payment's based off of.
Okay.
A lot of commercial loans though do like a 10-year term and like a 20 or 25-year amortization. This is all for commercial real estate is what I'm kind of talking about. And the rate's only fixed for 5 years. So let's close today. The rate's fixed for 5 years. On year 6, it'll adjust to whatever the market rate is. And each bank uses different indexes, whether it's SOFR, FLUB, Prime, whatever it is, then plus a certain margin. And then it's fixed for another 5 years. Then at the end of those 5 years, so 10 years total, you have a big balloon payment because the payment's based off of 20 or 25 years.
Oh, okay.
Yes.
And at which point you either refinance the balloon or you've got the money to pay it off.
And hopefully you have the money to pay it off.
Yeah,
but generally people refinance, or a lot of times with commercial, they need to get a new roof or they need to buy something else. So they refinance, maybe do a little cash out and use it to.
Yeah. So like when I bought my building where we have our company headquarters.
Not with my bank.
That's right. That's right. I didn't know Casey back then, by the way.
Oh, okay. All the way back then.
Way back then.
Way back then.
But, so we actually have a loan that is amortized over 25 years, which means the payment is calculated based off of that 25-year payoff.
Okay.
But it is only a 5-year guaranteed rate, right?
Okay.
So that at the end of 5 years, then we have to basically renegotiate
Got it.
the terms.
So it's a 5-year term as well then? Okay. I'll be knocking on your door in 4.5 years.
You know where to find them.
Mark it down.
It's got a big sign out front. Yeah.
Unless rates become more favorable, then I'll be looking at trying to get that down, But that's the concept, right? So when I did that, it was really foreign to me. I didn't, I was like, what do you mean 25 years but only 5? And it's just the math.
Yeah.
It's just the math.
So on the income side, so if I'm a business owner, like we talked at the beginning, like if you're residential, it's gross income and all that, but that's fairly straightforward. If you're normally employed, give me a pay stub, that kind of stuff. But I imagine the process on the income side is different for commercial, as far as, how do you, I can tell you how much money my business makes, but I'm sure there's a documentation process and there's things that count and maybe don't count, or are there some common things people don't think about as far as when you're evaluating the income side, that, can cause hitches?
With when it comes to commercial and income, lots of business owners write off a lot of expenses because they want to look like they're not making money on paper, so they don't have as high of a tax bill. That being said, you can only write off commercial expenses. I don't want anyone to get in trouble with the IRS. But with that, there's a lot of non-cash expenses, so depreciation, amortization, interest, because we're going to add that back because we're calculating the entire loan payment. So there's a lot of add backs we can do. An example is let's say a landscaping company. They got a lot of lawnmowers and trucks and lots of heavy equipment that depreciates pretty quickly. So, I've seen, hundreds of thousands of dollars on depreciation, which then we can add back. That being said, they're going to replace that at some point, so maybe we only add back half of it if it's a lot and they know they're going to have these purchases later on.
Oh, okay. Because if I deduct my depreciation, that's not actual money I'm spending. So I might have $50,000 in depreciation on all this equipment that I own, but I didn't actually spend.
It was a non-cash expense.
Right, non-cash expense.
So we go with EBITDA a lot, so it's earnings before interest, taxes, depreciation, and amortization.
Okay.
So the big thing there, though, is you want to look not that good to the IRS, but if you want to potentially get a loan, you need to at least look decent enough to be able to get a loan.
Well, that's kind of what I was getting at. I'm like,
And then, not only that, let's say that you're getting towards the twilight of your years of running your business and you want to potentially sell your business, right? You are going to get offers based off of your profit, your net earnings, right? And if you have them looking really awful for the purpose of not paying a lot in taxes, which you can if you're within the legal bounds, right?
Right, yeah.
But you want to also make it look good enough to a buyer to pay you the real value that's there. So it is very much a balancing act. So when you're doing lending specifically, those debt payments can come into that overall valuation on a company for the purpose of selling it to someone else or whatever. But they know that that's also temporary, not ongoing technically, right? Once the debt's paid. So lots of nuance for business owners to understand, especially when they're trying to sell. You need probably a good 5-year window to clean up the books and make it look like it should look to a potential buyer.
Right. And just, get to eat the tax bill a little bit there.
You do.
Yeah. So if it's existing business, that makes sense. Maybe I want to, I got an old building, I need to buy a new one or buy equipment or whatever. But if it's a new business, I'm curious, like if somebody's got a new business or like an expansion where, you want to borrow in order to expand, but obviously you know what you hope you're going to make. So if you're like a restaurant, I'm going to open a second location. So I want to borrow to do that. Well, can I just, do I just base, like, how do you, what work is involved there to say, okay, we'll lend you the money because we think in the future you're going to make more, right? I mean, I might borrow if you're borrowing for expansion, then the hope is you're going to make more. How does that evaluation? Like I bring in my business plan and.
Yeah. So we want to see business plans, projections, and expansion's a lot easier to get approved versus a new business, a startup, because there's no history. With an expansion, at least there's history of, this restaurant's been doing really well. They can replicate it, and they're doing really well in Johnstown. Maybe they can replicate it in Greeley or Fort Collins or something. So, yeah, we look at business plans, projections. We want to. And a lot of, the 5 C's of credit are, cash flow, credit score, character, 2 others that I'm forgetting. And
I bet they start with C.
Exactly.
Yes.
But those are all part of it. So cash flow is a big part of it. Oh, collateral. That's one I was missing.
Okay.
And so with startups, if it's a new business, no history, but they have, a free and clear building or home that has no liens on it. That's a lot easier to get that done because, the bank is secure at a lower LTV or loan to value. That's another big thing banks look at. Yeah.
So I'm curious, let's say in the digital world that we're living in, right? We had to our audience, we had a nice robust conversation before the podcast started about AI. It's a big deal right now, but you have a lot of people who are living in a digital world and they're making their revenue and income for a business from that. Is that any different, right? There's no brick and mortar really to evaluate. There's a product, there's maybe a video product or something like that they're actually creating, right? It's a creation type
like a
situation.
monetized YouTube channel, for example.
I was just thinking, if it was a small, mid-grade to low-grade YouTube channel.
Low grade. Ouch.
Are there any kind of other hoops to jump through or to the bank has to take into consideration to lend to those kinds of things? Because let's say they ran out of their basement. They're like, well, we're getting big enough now that we want to kind of maybe have our own studio outside of the out of the house and have their own place. And anyways, so what would be the thing that you guys look at in that regard?
Kind of like you were saying earlier, cash flow is king. So if they're cash flowing and making money and can service debt payments, it's as long as it's legally permissible. We don't really care.
So the track record is probably the biggest piece of that then.
Well, track record and collateral, I'd say. So for that instance, it's all online. They don't have, accounts receivable or inventory or equipment, but they're looking to purchase a building. The buildings obviously are collateral, and so we're secured and there's cash flowing to pay us back.
In case you sell some merch on that channel there, Jeremy.
I don't think so. I'm going to sell some books.
Well, that'd be good.
There you go. Yeah. So are there other common like pitfalls or like, when people come in and, it's the first meeting and you're like, man, I wish they would do this. Like, is there a consistent, like, oh my gosh, just, if you could be a little bit more prepared for this first conversation or whatever.
A lot of people come in with, I have $50,000 in equity in my house. Okay, but what's the lendable equity? Because we have to margin it, and so depending on the type of real estate, the primary residences are a lot more safer because people are going to make that payment. They don't.
Yeah, they want to live in their home.
Yeah, so we can go up to a higher margin. So an example, if you have a $500,000 house, we can go up to 80% loan to value on that.
Okay.
So the $50,000 in equity, I mean that's not lendable for us, because in the event you defaulted, we had to take the home and sell it. You know, banks aren't landlords. We don't want to hold on to real estate, so we're going to sell it at a discount and just get our money back as quick as we can. Or in 2008, you know, banks were lending up to 90, 95%, really high loan to values, and because they thought real estate couldn't go down. Obviously, that's not accurate. And so since then, banks have really kind of pulled back on.
Wait. Could you say that again?
Real estate can
I've
go
heard
down?
this from many people that tell me that real estate is a guarantee.
Come on.
It is. Just like taxes and death, right?
But it's not only going to go up. It's not only going to go up.
Real estate
You're going to
will
have ebbs
fluctuate.
and flows on that, just like everything else.
And I mean, we'll look at office buildings in the last 4 years. You know, they were super high. They're all the ones in San Francisco and New York for $500 million and got discounted down to $200 million.
Have you heard about the building in San Francisco? Not to blow it up our conversation, but the building is leaning.
I have heard this. I actually watched a whole video on it. They think they fixed it.
Oh, really? Like it's like a huge skyscraper,
I've not
right,
heard
in
of that.
downtown San Francisco.
Yeah, it's like
it's
more
leaning,
than
and
it should
yeah, they have to figure out what the solution is.
But I
There's
think, but honestly, there's still a lot of, like, downtown Denver is empty still. I mean, my understanding is there's still, and unfortunately, like, those buildings are not easily converted into anything else because just the way they're built. Office buildings are not built like you build apartment buildings, so you can't just you can't just turn them into apartments or anything. So
Well, there's a lot of developers doing that, trying to convert them to apartments. But no, I mean, there's, you know, Amazon's had the big push to get back to the office, and I mean, I think a lot of employers are having them come back, but yeah, it's.
Well, I think
still
they've found it's just you're more productive by being at least some
I
of the
think
time
so.
in the office. You know,
That doesn't make sense.
Yeah,
right?
but
How dare you?
But I know a lot relocated. I mean, I can think of a couple people I know who worked for businesses downtown that now took up office space in Broomfield or Aurora and basically looked at where their employees lived and said, well, y'all live over there, so I guess
And it's cheaper.
So, you know, we'll just do it that way.
So you mentioned loan to value just a minute ago, you know, which really comes into down payments, right? So what is a typical situation for, let's say, a residential loan versus a commercial loan for down payment requirements?
Residential loans, you know, I'm not an expert on those, but I mean, you can go as little as like 3% down versus, you know, your property, a commercial space owner occupied. We're going to require, for a traditional loan, we're going to require at least 20% down. That being said, there's the SBA, the Small Business Administration. They have a nice program called the 504, which is you only need 10% down. Then the SBA finances 40% and the bank finances 50%. So it makes the bank a lot more comfortable because we're at a lower loan to value. So if you were to default, we're in first lien at 50%, and then the SBA is in at 40%, but in second lien.
Got it. So yeah, and I actually did look into some of those programs when I was buying my building, but there's a lot of red tape and a lot of strings.
Talk about hoops to jump through.
Yeah.
I mean, you're working with the federal government, so it's lots to go through.
And they do put restrictions on what you can and cannot do with that property too, for a certain period of time.
And you got to occupy 51%, and there's lots of different things. But you know, and when rates were super low 3-4 years ago, that was a great product because that rate's fixed for the whole life of the loan. So a 25-year fixed rate at
that's pretty sweet.
3-4% is awesome
On the commercial side.
Yeah, versus our rate's gonna, you know, maybe it's fixed at 4%, but that's only for 5 years.
So we're recording this in this is early 2025.
Yes.
So where are rates today for commercial lending? Just, I mean, broadly, obviously, I'm not going to hold you to it.
Well, yeah, it, again, depends on the whole deal. But I'd say anywhere from 6.5% to 8%. Really depends. I mean, you know, we're super strong deal. You know, good cash flow, good liquidity, low loan to value, maybe in the 6s. Not so strong, you know, 7.25%, 7.5%, maybe 8%. So it really depends. Which is always tough, and because people always ask, "Oh, what are rates at?" Well, it depends.
Yeah.
So I'm glad you brought up the SBA because I was curious about that. So if I'm somebody who has, especially if I'm in startup mode, like I've got an idea for a business, I want to do it. I'm gonna run it out of my home, so I don't need, I'm not looking for real estate, but I've got all the other expenses, right? I gotta buy materials for whatever I'm doing. Maybe I gotta buy a little bit of equipment. I need to, pay myself a little something, while I'm doing this. I think that piece holds a lot of people back. I think there's a lot of entrepreneurial spirit out there in our country. I love that about our country, but I think that initial, where do I get that initial chunk? So so I would have thought well, maybe the SBA is one of those places you go, or, whatever. But as far as lending on that side to basically get the startup, if you had something you wanted to, if you had an idea or something you were doing, maybe as a hobby, you want to make a profession out of it, that kind of thing.
Yeah. Kind of like I was saying earlier, the startup versus expansion. Startups are a lot harder to lend to, unless there's, let's say your rich grandpa's willing to guarantee the loan or something like that, and he's got good reserves or good collateral he can put up. That's usually what's needed, at least until 2 or 3 years of kind of a track record and showing that you can pay it back and handle it. Then we can always look at releasing the additional guarantor. There's also hard money lenders, which they lend when banks won't. When the customer is non-bankable and the person still wants the loan and they're willing to pay a higher rate because let's say we're at 7%, a hard money lender's at 15 or something like that.
Is that the mafia you're referring to?
I'm not saying anything.
Do they break your thumbs if you can't pay?
There's a few baseball bats.
Interestingly enough, however, we're speaking in the commercial area, of course. So if you want to borrow, you are going through some process, right? Sure. And you have to look at financials, and it takes some effort. Well, if you're in a situation that I just ran to a client, did this recently, that you need some cash fast, but you don't want to have to go to the bank to get that money because you just need it for a short period, let's say to make payroll. Mm-hmm. So the concept was they actually go to a high-end pawn shop, and they actually will pawn, let's say they have an excavator, and they'll pawn their excavator to the pawn shop. The pawn shop has a great relationship with the local bank. Mm-hmm. So they'll actually send it to the bank to get the cash. They don't have to have the cash on site or anything like that. So that then they can just move it into their account. They don't have to take a bag of money around somewhere, right? Oh. But then they can make their payroll, and then they're, so it's a construction person, let's say, and they need to pay, the bill hasn't been paid until 2 months later, and then they finally get in, the money's there, right? The job was done already. But that's a way that I've heard small businesses creating cash flow in cash flow crunches trying to get by.
On shop.
Yeah, the story I was saying was short-term money is needed for a small business owner. So they have a project they completed, but they needed to meet payroll and they didn't have the money, and they didn't want to go to get a loan for 2 months or whatever of cash and jump through all those hoops. So they just went and pawned an excavator and paid for their payroll for their guys, because they didn't want their guys to wait, so they had to pay their guys, and then they just went back and got their excavator when the project was paid by the person actually.
Yeah. Well, that's funny, because I know I've listened to things before where they've talked about before credit cards were mainstream and everything like that. Before that, that's what pawn shops did for people. Right, that was your short-term borrowing for people. Is you had the one expensive ring, or you had the one thing of value, and you would go down to the pawn shop and pawn it for a little while. And obviously that's still a thing. Pawn shops are still a thing, but I don't think they're providing as much of that banking function as they used to. But it's interesting on the commercial side if that's still a thing. But if you've got a lot of expensive equipment, I suppose that makes sense. And and not worth going through all the trouble to do everything you got to do to get a formal loan for a month.
Yeah. Well, and part of it is also, it's let's say that they had that credit issue for some reason, and they needed to, they needed to pay their guys, but maybe they even couldn't get a loan for the reasoning of their credit rating or something,
Right.
But it just gives another alternative to get to cash and cash flow,
right,
to help keep the business going, because that's what all these business owners run into, right? Mm-hmm. Cash flow issues, and economies boom and bust, and we have to be able to navigate through that. And just one more tool in the quiver, right?
Well, and if you have assets, that's the thing too. We have that big auction yard down south of us here where they do a lot of commercial equipment stuff. And it always amazes me how it fills up with a bunch of stuff. and then it all gets sold, and then it fills up with a bunch of stuff. But what somebody told me was like, oh yeah, if you're a construction company, you got a big job, then you go down there and you buy 20 trucks for this giant job you're doing, and then when the job's over, you take them back down there and sell them to somebody else who needs them. And it's just like, oh, okay.
Yeah.
You don't want to just sit on them because they're not working, right? For the next project or something. So you got to do something with them. Yeah.
So what other pitfalls or things you think, or just some kind of like best practices for people if they're in that small business game, especially, and they're looking to maybe expand, maybe thinking about borrowing?
One thing is, most businesses want a line of credit at some point. And I always tell, the best time to get a line of credit is when you don't need it, because when you need it is when your financials usually don't look the best, and it's tough to get one. So, yeah, I always tell everyone, if you think you'll need one at some point, get it now. And even if it sits at a zero balance for a year, and yes, when we renew it, there will be some renewal fee of some sort, but it's kind of the, it's the cost of doing business. It's us giving that service to them in case they need to draw on the line to meet payroll and not go pawn an excavator or whatever it is. But yeah, best time to get a line of credit is when you don't need it. That's for sure.
Yeah. I have people do that a lot of times just from their personal residence to get a home equity line of credit set up so that they can access it in a worst case scenario if they needed to.
Furnace goes out or needs a new roof, whatever. Yeah.
So it allows us, to sell something out of the market potentially to pay that bill. But if it's let's say the market's not doing well at that point in time, we can kind of wait for the rebound and then sell.
Oh, okay.
So sell at the right time, not the wrong time, kind of thing. So it just helps with, again, trying to be able to get the cash when you need it and maximize the return on the different assets you have, whether it's a business or personal assets or stock market assets, right?
Mm-hmm. And I'd say another thing is, we touched on it before, and while you were getting the new drive, Roy and I chatted. It's a lot of people will say, "Oh, I bought this building a year ago. The value is $100,000 more. Oh, that's great, and yeah, you could sell it for that, but we have to go off the lower of the purchase price or appraised value if it was purchased in the last 2 years."
Oh,
and that's most banks.
So even though there's a big remodel that's been done, you don't get to really count that in there until you
a big remodel where you did like the electrical and the wiring.
Well, and that's a little different because he did enhance it a lot.
Oh boy, did
talking about my building for the listeners out there.
Oh my gosh!
But yeah, and you can add the cost of that, but generally it's the lower of purchase price or appraised value if it's within the last 2 years.
I'm a little surprised you don't have like a screen running somewhere with before and after pictures of your building, like in the lobby or something. So
it would be kind of cool if we did
that.
That would be kind of cool to do. Maybe I'll think of that.
There you go.
I did have something here. Let's see. I'm gonna pull it up on my phone that I had a question for you on. Oh yeah. So the question is right now, everyone always asks me like, how's it going out there? What, economically speaking. So, what are you guys seeing in the lending world on the commercial side? Are things kind of slow? Are they moving quickly? Are they normal? I mean, where are we at?
It's nothing like it was during COVID. I mean, that was crazy just because rates were so low. Everyone knew like this is the time to get that low rate. That being said, last year was pretty slow. It was an election year, so I think a lot of people were just on the sidelines waiting to see what happened. Also, that was the first full year of higher rates, so I think the sticker shock is off a little bit. A 7% rate it's not as bad as it was a year ago when 6 months before it was 5% or something like that.
Yeah.
But no, we're staying busy, but definitely, like I said, in the last 2 years, a lot of projects have been sidelined. We're just kind of waiting to see what happens. A lot of development has, housing development. I mean, that's still going pretty strong around here. I mean, we're in a good area for that, but it's a little slow, but there's still deals to be done, and a lot of people just the math didn't make sense, so now they're going on to something else.
Yeah.
Well, there's probably some pent up demand too. I mean, everyone's because they've been sitting on the sidelines. I think you see that in the housing market too. I mean, we bought last spring, which is probably one of the worst times you could buy. But life circumstances, you don't have a choice.
Hey, date the rate and love the house, right?
Yeah,
You can always refinance.
Yeah.
Well, you can if it goes lower.
Yeah.
But that's like buying land. It doesn't always go up. Rates don't always go down.
Right.
So
True.
I always tell people when they're borrowing, just make sure in a worst case scenario, you can pay this. If this is the worst case scenario, you can make these payments.
Mm-hmm. Yeah, that's
and
what
in the
we
best
did.
case scenario, you hopefully can refinance down in the future, but in the worst case, we're good.
Yeah. There was a couple times like, well, in about a year, it's probably going to go down. So you can. I'm like, nope.
Yeah, if you talk to realtors or lenders,
Hey, not this guy.
sometimes they paint a little more rosy than it maybe is. And me being an economics follower and knowing what's going on in the economy, some of the numbers weren't adding up that I didn't think we were going to see the rate drop that some of the realtors that I know and even a couple lenders that I know as well weren't as quite as favorable, I thought, as what they were projecting.
Yeah, well, we're both good at seeing. Everyone's good at seeing what they want to see.
Yeah.
We have these natural filters. Okay. So
No, I personally, I don't think rates will. I think they're going to hold steady.
I think so too, and I think they need to.
Oh yeah, and historically we're like at the average pretty much.
Yeah.
So it's something crazy.
When I bought my first house in 2001, and we got it down to 7%, and we were super excited. So when we bought this one last spring at 7%, I was like, well, we've come full circle.
My boss bought his first house in I think the 80s, and he's like, man, we got like 11%, and it was an awesome deal.
Right.
Yeah.
That house was $140,000 I bought in 200001, so it's a different kind of
Exactly.
thing. It's like prices. It's
Yeah,
a whole other thing.
When I bought my first home in 2004, the rate I got was 6.375, and I thought that was a lot. When you're looking at the math of it, and I had a conversation with my dad about it, and he's like, I've seen rates in my lifetime that have been in the double digits. He's like, if you can get a 6, you lock it in. If it goes down, sweet. If not, he's like, that's the best rate I've ever seen in my lifetime. Yeah. As an adult, right? So that's what we did, and I did get a refinance down eventually, but that was an interesting. I didn't have any historical perspective on that, right? So I think people educating themselves around that, and making sure they understand, like, okay, what does it look like today? But that doesn't necessarily mean the past or the future are going to look the same. And just go off of those finances today, run the math, be smart about it, have a good down payment, right?
Yep.
Have a good quality lender, right? We don't need a payday loan, right?
No.
Necessarily, right?
And a good lender is a lender who will tell you, no, don't do this loan, or that's one of my least favorite things of the job is denying the loan, but it's also like, hey, you may want to hold off on this or get more down so your monthly payment's lower because, a lot of people are got to get in that house no matter what, and then they're house rich and cash poor.
Right.
What are you doing on assets that, and this is maybe a little bit off, but I'm just thinking of this. What are you doing on assets where, let's say that it's a crypto asset? Are you putting any value on those?
No. We're just a more conservative lender, and that's just it. So we're more conservative, but we're steady. Good times and bad times, we're going to lend the same. Versus some banks, in the last 2 years, they really shut off their lending, but when it was a good economy, they're going gangbusters and lending out like crazy. But as far as crypto, we won't touch it as collateral or anything. But that being said, I personally have a few customers who have done quite well on crypto. But,
allegedly.
No, they sold
turn it
it
into cash
and then used me to go buy rentals and whatnot. So yeah.
Now that's what you want to do. But I've had many stories of people losing or they're holding and they there's no value until you do something with it because it's all what is the value of the cripple? It's based off of the value the dollar says it's worth,
right?
Or the open market says it's worth in dollars,
right?
And that's the actual value, right?
It comes back to dollars.
Yep. Yeah. So we'll see how that goes going forward, but I think that's going to be an ongoing thing of evaluating what is the value of those kinds of assets and how do we lend or not lend on them.
Well, and there's some banks who will lend on that. I mean, there's a lot of different banks. Silicon Valley Bank, they were big in tech startups and lending on those, and we won't lend on them. I mean, again.
Yeah, that's an interesting choice you picked there. That's an interesting example you picked there.
Well, with crypto, it's a little riskier. So there's always and banking entirely is just about managing risk, whether it's deposit interest rate risk or lending rate risk. I mean, that's all it is interest rate risk.
Right. Yep. Well, this has been fascinating. I always learned a bunch.
Yeah, so lending is a big part of just life, whether it's personal, residential side, personal loans, car loans, right? Those kinds of things, college, And then on the commercial side, especially, that's what runs the world. I mean, that's where the paychecks come from. Some business started somewhere, and even if you work for a gigantic company out there, like they still have to make payrolls. And I've seen big companies like that have to do short-term loans to meet their payrolls because they have the same issues that a small guy has. They can just maneuver a little bit more easily. So those small guys have to be really careful on how they position themselves to weather bad storms, and that's when they go belly up. So if that's you out there, just be aware of opening those lines of credits, having a good lender, making sure you have good loan to values, and trying to make good financial decisions around those.
Especially anybody who's got a seasonality to it. If you're in retail and it's like Christmas, you're just hoping Christmas is great, and then. We were talking about this in our finance committee here at the Life of the Church. Like, we get a good chunk of giving at the end of the year, which is wonderful. And then, you get to January and you're like, okay, back, but it's hard. It's hard. So.
Yep. It's the ebbs and flows. And that's why lending's so important, is it helps us kind of smooth out those ebbs and flows.
Yeah. So if somebody is in Northern Colorado, Casey, and is looking for a good, solid commercial lender, how do they get a hold of you?
You can text, email, call, drop by a branch. I'm always happy to have a conversation, just kind of educate people, because that's what good lenders should do is educate people on options they have, and what if this doesn't happen? Well, then we're gonna take your house or collateral. So it's just showing them that there is a risk to taking out loans. And, I tell everyone, interest pays my salary, but pay your loans off as quick as you can.
Yeah. What would be a good email to reach you?
Good email is just my name, Casey, CASEY .Madigan, MADIGAN @bankofcolorado.com.
Awesome. And do you have a phone number you'd like to drop as well?
You can always just call or text my cell, 970-231-7074.
All right.
Awesome.
And Bank Colorado, all over Northern Colorado in general?
We're all over Colorado in general. We're about 52 branches, I think, in Colorado.
Okay.
We're one thing I like about Bank of Colorado is, so we're Bank of Colorado in Colorado. We're in 8 states total. The other states, we're Pinnacle Bank. Our parent company is headquartered out of Omaha. But
Go Big Red.
There's another bank in Omaha.
There's a lot of banks in Omaha.
Yeah, a lot of banks in Omaha.
I don't know what it is about Nebraska, but a lot of banks.
They got nothing better to do.
I believe Warren Buffett might have something to do with that.
Get a Warren.
Exactly. But we keep the community bank model, so we're really big on giving back to the community, whether it be sponsoring, giving money, volunteering. We're big on that. So we have that model, but we kind of have the horsepower of a larger bank, which is nice, because we can do deals that small banks can't. Obviously, we can't do deals that Wells or Chase or we're not going to lend $500 million to buy an office building or anything like that. But usually, if it makes sense for the bank, makes sense for the customer, we can get it done in some sort of fashion.
Awesome. Nice. Very cool. Well, thanks for joining us.
Oh, thank you guys for having us.
Appreciate you, Casey. Appreciate you, Roy.
Thank you.
All right, everybody out there, please like, subscribe, do all the things. If you found this interesting or exciting, share it with your friends or anybody else, especially anybody who might be looking at that commercial small business lending need. That's what this is for. All right. Well, thank you guys.
Thanks for having me, guys.
Have a great day.
CWA is a Securities and Exchange Registered Investment Advisor. No content contained herein should be construed as an offer for investment advice or an offer for the purchase or sale of any security, insurance, or other investment product. Investments involve the risk of low loss, including loss of principal. Please consult with a qualified financial, tax, or legal professional before implementing any strategy presented here. Data presented here are obtained from believed reliable sources but cannot be guaranteed as to completeness or accuracy.